Expected market return? Why would you invest? Or you it could be, in which case you won't buy stocks. It can't be collectively negative. Nobody would buy stocks. Yeah, well, once you've gone into negative territory, might as well leave the cash in your under your bed, right? Okay, folks, you ready for the two questions? How many of you picked a company for your valuation? Okay, more hands than last time. We're moving in the right direction. So next Monday, question is going to change, right? How many of you have not picked a company? So hopefully the numbers will shrink. How many of you are not in a group yet? So those 15 names that I see on the orphan list, they're not orphans anymore. You've been adopted. There are a lot of names there. I mean, it's still there. So if you're no longer an orphan, remove your name from that list, right? You're not in that list anymore. So at least people know that they need somebody for their group. So today we're going to continue our discussion of risk-free rates. We're going to complete it, but we're also going to start on this mysterious concept, which is the equity risk premium, which is what you would demand over and above the risk-free rate to invest in stocks collectively. So I'm going to start today's class with a test about the equity risk premium and lay the foundations of how we think about estimating it best. So the tough thing about equity risk premiums is you're trying to estimate what people think they can make on stocks over and above what you can make on something risk-free, right? So what's the most logical place? So if I asked you, what do you think you'll make on stocks over and above T-bonds? What's the most logical place to start? Look backwards, right? We have 100 years of stock market data in the US. And if you take 100 years of stock market data, you can slice and dice it. You can use a historical past. And if you're doing it, you're making an assumption, right? You're assuming that the future will look like the past, but we do it in so many other places. Why not? This is the default way in which people estimate equity risk premiums. Especially in the US, they look backwards, a lot of history, and they use it as a prediction for the future. So let's say you decide to go down that path. Here's my first question. You want to estimate the equity risk premium for the future. You can just look at the last year. What's the most recent data? What did the number look like last year? What did stocks do? Does anybody know? 25%, right? Roughly 25%. So what was the, and you know what T-bonds earned last year, right? Minus 1.6% because the price actually went down. So the equity risk premium last year was 26.6%. You want to put that as in your equity risk? It'd be nice if we could make that. But there's no way you're going to get there, right? So what's the problem with 1 year? It could be a good year, it could be a bad year, it could be so clearly not one. How about the last 5 years? You think that will be good enough? What's the question you're really asking, right? It's a statistical question. How noisy is the average? In statistics classes, how do we measure? When you compute an average of a bunch of data, what are you trying to put in brackets below it to indicate to the world how uncertain you are? A standard error, right? A standard deviation, but a standard error, basically saying it to be plus or minus. You know what a 5-year number is going to look like? The plus or minus is going to wipe it out. Not 5 years. I've heard people say, well, if I'm going to project out cash flows the next 10 years, I should look at the last 10. This has nothing to do with what you're projecting out for. So that shouldn't even enter the equation. There are others there. If you're going to do a 10-year bond rate, nope, nothing to do with that. Ultimately, what you're trying to do is, even if you believe the past is a good estimate of the future, you're trying to come up with a number that you have some degree of confidence in. And I'll give away where I am. There is no historical time period you could give me where I feel comfortable enough with the number you're going to give me that I can value stocks with it. So I have to give you an alternative. But this is how 95% of valuation, the equity risk premium comes from looking at the. So I've made up a year. Let's say that you're coming off a terrible year for stocks. We haven't had one since. So let's make it 2022. Terrible year for stocks, down 20%. You're computing a historical risk premium with that year added on. So basically, you've been doing a track. The data in the US, the most widely used data set is from Ibbotson Associates, goes back to 1926. It just gets updated with the most recent year. So let's say you computed through 2021 and it was 5.5%. Then 2022 happens and it's minus 20%. You add the minus 20% to your historical data. What is that going to do to your equity risk premium? Decrease it or increase it? It's going to drop it, right? You think, so what? So you're coming off a terrible year for stocks, and what are you telling me? I'm going to demand a lower risk premium from this point on, which makes no sense at all, right? You come off a terrible year, you're feeling scared, you want a higher risk premium. That's the second problem with historical risk premiums, is they're cut in the wrong direction. After a crisis year like 2008 or 2022, your historical risk premium gets smaller, and at the same time, you're feeling more risk in the picture. So what would you like? You'd really like a forward-looking number that reflects the world you're in. And I already said this is going to be a rocky semester because things are happening, right? I don't want to go back and look at the last 100 years. I want to live in the moment. I want to get a forward-looking number. And I'm going to give you a way of doing it, but I'm going to get you started on that. Right? So I want somebody to be my guinea pig in this process. So you're going to be my guinea pig, okay? So what's your name again? Akshar is going to be my guinea pig. I'm going to offer him an investment where I can guarantee $1 in cash flows every year in perpetuity. Okay? How much should you pay for that investment? Okay, so $1 is your cash flow. It's constant. It's a perpetuity. So I need a discount rate. What did I say? It's guaranteed in US dollars. So right now that rate is going to be a T-bond rate, but let's say it's 5%. Let's round it up, right? 1 over 0.05, which is $20. You see why $20 is a fair price, right? You pay $20, 5% of this, so you'd pay $20. I'm going to up the ante a little bit. Tyler, I'm going to come to you with $1 every year forever, but it's not guaranteed anymore, right? But I'm going to let you set the price. Obviously, would you pay $20 now that it's not guaranteed? No, less or more? Way less. Let's not go to the way less yet. Less, right? You see why, right? So give me a number. How much would you pay? $10, okay? If you pay $10, has Tyler given away what his risk premium is looking forward? With a $10 investment, what are you making? 10% on this investment. You have a 5% equity risk premium over the risk-free rate. Do you see where I'm going, right? The way I'm going to compute a forward-looking premium for stocks is I'm not going to ask you what risk premium would you like to make. I'm going to look at what you pay. And when you get scared, what do? You push down what you pay. You push up your risk premium. And will that number change? Every time the price you pay changes, the risk. We have a forward-looking dynamic premium. A lot of I's to dot and T's to cross, but that's where we're going to end up on the equity risk premium discussion. We're going to start with the prevailing status quo, look at the past, and I'm going to tell you everything that makes me uncomfortable with using that. And I'll also make a confession. Before 2008, I used to let people get away using historical risk premiums. Post 2008, I think you even lost the fig leaf. We say what happened in 2008 to change that shift away. But today we're going to talk about risk premium. So before we do that, though, I want to kind of finish off the risk-free rate discussion. So let's go back to where I left you in the packet. If you remember, I came up with 3 different ways of estimating the default spread for Brazil. Remember what the 3 ways were? I could use a Brazilian dollar government bond, compare it to the USD bond, and take the difference. It works only if you have a dollar bond. So if Russia has a euro bond, I can compare to the German euro bond and take the difference, the default spread. That number was 3.17%. The 10-year Brazilian government bond rate in reais was 12.3%. I subtract out the default spread, I come up, it should be 9.13%, so fix that typo, 9.13%. I'm subtracting out the spread from the 12.3%. The second approach, I looked at the CDS spread, 2.82%. If I subtract that from the 12.3%, I get 9.48%. The third approach is to use the local rating, which has a default spread of 2.83%. You subtract that out, you get a 9. So I get three different risk-free rates, right? 9.17 to 9. If I just picked based on the risk-free rates, and you wanted to get a high value for your company in reais, which one are you going to go with? The lowest or the highest? Yours, lowest, because you want a low risk-free rate. I'm going to make a statement that's going to sound absurd, but I'll back it up. It doesn't matter which of the three you pick as long as you stay consistent. See, consistent in what sense? A little later in the process, we're going to open up the box of equity risk premiums for countries like Brazil. And there we will have to come up with a default spread to come up with the equity risk premium. And there I'm going to ask you, what default spread did you use to get the risk-free rate? And I'm going to make you stick with that same default. So if you pick a high default spread, which gives you a lower risk-free rate, that's now going to show up as a higher risk premium. It effectively will keep you in check and give you. So don't sit here 2 hours trying to pick which of these three. Just pick one and keep moving. At least remember which one you pick. And then come back to it later in the process. So we looked at 3 tests. Let's move on to 4th one. Let's say you've decided that you want to do a valuation in real terms. I'll tell you, in the US, I almost never encounter a valuation or a project analysis done in real terms, partly because the world lives in nominal terms. In fact, on April 15th, try filing your tax return in real terms. So I've income, but I'm going to take inflation out of it, and I'll pay taxes on my real income. It doesn't work that way. The world operates in nominal terms, so it's easier to stay in nominal terms. When would you do things in real terms when inflation gets to be 20, 25, 30%? You finally throw up your hands and say, this is too volatile and too messy. I'm going to do things in real terms. So you're more likely to do this in Honduras or Argentina or Venezuela than you are in the US. And to do things in real terms, you need a real risk-free rate. And remember I showed you a real risk-free rate last session? The TIPS rate, right? You're saying, but that's a US real risk-free rate. A real risk-free rate actually is a real risk-free rate. There's no US attached to it. And in a world where there are no barriers to capital and trade, and that's a big if, a real risk-free rate should be a real risk-free rate all over the globe. And here's why. Let's suppose I told you the real risk-free rate is 2.3% in the US and 4% in Brazil, and capital flowed freely. Tell me what's going to happen. It's going to? The capital will move from the US until what happens? The 4% moves down to 2. I know that in the real world there are barriers that prevent, but if you're doing a valuation in real terms, I'm going to give you an escape hatch, but I want you to have the explanation ready because somebody's going to challenge you on it. So you're valuing a Venezuelan company in real terms. You pull the US TIPS rate and make that your real risk-free rate. You're going to get pushback, right? It's a Venezuelan company. You're using a real risk-free rate in the US, and the only defense I can offer is, in a world where things converge, this is as good a start as possible. So it's not perfect, but you can see why the TIPS rate can be used as a risk-free rate pretty much anywhere in the world that you're doing a real valuation, a real analysis, a real project assessment. Now let's go back to a question I asked you at the start of last session. Right? We talked about risk-free rates in different currencies, and we talked about how to estimate. So now we have a way of estimating risk-free rates. So the start of 2025, I estimated risk-free rates in about 40 currencies. You know, I had to stop at 40. I needed a government bond rate in the local currency to get started. There are only about 40 currencies where there's a local government bond rate in that currency. Then I cleaned up like I did for the Brazilian. So the gray part of this graph are the risk-free rates in different currencies. I think you kind of answered this question last session, but since it's such a critical answer, I want it to be affirmed. Why do risk-free rates vary across currencies? I didn't ask why do government bond rates, right? It's why do risk-free rates vary across currencies? What's your answer to that question? Yes. Inflation, that's it. It's the only thing. You're saying, but don't risky countries have high? No, if it's truly risk-free, I've taken out the risk effect. The only thing that causes risk-free rates. So high inflation currencies will have high risk-free rates, low inflation currencies will have low risk-free rates, and deflationary currencies will have negative risk-free rates. It can happen. So when you look at difference in inflation, you'll essentially see risk-free rates vary. Can risk-free rates change over time? Of course. Why? Because inflation changes over time. This is from 2020. Risk-free rates in the US, Treasury rates collapsed. There it is, right? That's the start of 2020 through, it's not even the start, February 14th of 2020 through March 23rd, across the board rates collapsed. Why? COVID shut things down. Inflation kind of dissipated, right? What could you do, go buy? Consumption dropped off. Real growth, of course, dropped through the floor. So not only do risk-free rates vary across currencies, they vary across time. I have some bad news for you. You value a company today, what's your risk-free rate if you're doing it in dollars? 4.5%. When is your project due? May 5th. You might have to at least change the risk-free rate closer to that date. You don't have to redo the whole valuation, but it could change your buy to a sell. So don't pull the trigger on buy or sell till much later in this process, because who knows what rates will be 10 weeks from now. Rates can change across time, different across currencies. But if inflation is the reason why rates vary across currencies, and now have an opening on how to estimate a risk-free rate in any currency. Remember I showed you the graph with 40 currencies which had government bonds? There are lots of currencies on that, or not on that list. The Egyptian pound, so you can go down the list. You're saying, what do I do with those currencies? Here's a quick and easy way to get a risk-free rate in any currency. In 2015, I was valuing an Egyptian bank, and I really, really, really wanted to value it in Egyptian pounds because I'd never valued a company in Egyptian pounds. I went looking for a government bond rate, none. The Egyptian government borrows money, but it borrows from the World Bank, it borrows from banks, it doesn't issue bonds. So here's what I did. I started with the UST bond rate. You're saying that is so US-centric. Guilty as charged. But I trust the T-bond rate because it's a traded rate. There's demand and supply setting it. And it was, let's say, 2%. I'm sorry. It was roughly 2%. So this was risk-free rates were low. And then I estimated two numbers. One was the expected inflation rate in the US, which then was 1.5%. And the second was the expected inflation rate in Egypt, which is 15%. Let me pause right there. The Egyptian inflation rate is roughly 13.5% higher than the US. And if inflation is the reason risk-free rates should be different, the risk-free rate in Egyptian pound should be roughly 13.5% higher than the UST bond rate. So if you're in a hurry, you take the 2 and you add 13.5, you come up with 15.5%. You're saying, what's this convoluted calculation you did? Rates have a compounding effect. Inflation is on top of real rates. If you want to do it more precisely, you take 1 plus the US dollar risk-free rate, you take 1 plus the inflation rate effects, and you come up with a more refined. You see why, if you're in a hurry, I'm going to let you get away with 15.5%. After all the refining, you got 15.57. Okay? But it's good to know the full calculation, because your inflation gets to 50, 80, 100%, do the full calculation. There, the effect will be large enough that you will notice. At this point, you have no excuse on any currency to say you cannot come up with a risk-free rate in that currency. As an estimation question of the numbers here, what might be the number that you have trouble with? T-bond rate you should be able to get, right? Inflation rate in the US is trivial. It's easy to get. All you have to do is compare two market numbers. What are the two market numbers that you can compare to get an inflation rate? T-bond rate and a TIPS rate. Make them both 10. They're both, so you can take that difference. Which leaves you with the number that you're going to have trouble with. It's how the hell am I going to get an expected inflation rate for Egypt? Try the IMF or the World Bank site. They have estimates of expected inflation. Are they going to be wrong 100% of the time? But as long as you use that same wrong inflation rate in both your numerator and your denominator, you're going to be okay. Again, this is not the fight you want to spend days on. It's not worth it. Make an inflation judgment, come up with a risk-free rate, and move on. So on January 1st, 2022, the 10-year T-bond rate in the US was 1.51%. It's two springs. I measure my teaching life in spring semesters. That was 2 spring semesters ago, 3 spring semesters ago. 1.5%. Historic lows, right? So when you look at a rate like that and you're an analyst, you say that rate looks too low. It's human nature. So what do you want to do? You want to replace it with something that you feel more comfortable with. So in that decade when T-bond rates were really low, there were practitioners who replaced it with what they called a normalized rate. We talked about this being a subject. So you could take for normalized, you could take an average over the last 30 years, so basically you could replace the current rate with that. Or maybe you can use the current risk-free rate and keep moving. So the question is, should you replace a rate that looks too low or too high with something that you think is more normal? What do you think? What sounds more realistic?
I think you do the first 2 years of the risk period that you have and then adjust it for 4 years, 5 years down the line.
To what?
Something maybe more consistent with the last 10 years.
But should you be measuring consistency with the last 10 years or consistency with the inflation numbers you're using in your cash flows? You see where I'm going, right? So if you tell me that inflation is coming back after year 5 and rates will go up, then that inflation should also be showing up in your cash flows, which means the net effect of changing your risk-free rate is going to be far more neutral than you think. Because whatever you do to your risk-free rate, you should also be doing to your cash flows. So if inflation is the driver, my advice to you is this: leave well enough alone. You have enough on your plate already. What the heck are you doing trying to forecast interest rates for the next decade? Leave the T-bond rate at 2%, but then use a really low inflation rate when you do your cash flows. You won't get that assist. And that's going to keep your value. So consistency here just means whatever inflation you're building. And that's part of the reason I would not try to replace current rates. Yeah. And as I said last week, you tell me how old you are, and I can tell you what normal looks like. Most of you look at a 4.5% rate. And what's your reaction? Looks really high. Why? Because you've lived in a world with 2% rates. I had a 71-year-old in my valuation class. Alumni are allowed to take my MBA valuation class. He started in the market he got his MBA in 1978. He looked at the 4.5% and said, "What do you think?" And he said, "It looks really low." Because his frame of reference is 1980s T-bond rates was 6.5, 7, 7.5%. Normal is not some magical number. It reflects, that what we define as normal is set around 30 to 35 years when we're. So what you see then, so what you think of as normal music is what you used to listen to. So you notice that, when you get to be 65, you say, who listens to the crappy stuff? What is this, It's just a reflection of the fact that your normal got stuck on 30, and that's part of the problem here, is you're stuck in time and you can't really let go. So I know it's tough to do. And analysts break this rule all the time, in fact, in my spreadsheet, I allow you to change. I will give you the rope to hang yourself if you want to do it. But I want you to think long before you pull that rope out and say, do I really want to do this? And that's the other question. Remember the fact that rates were low for the last decade? Who will we blame? The Fed did it. Everything, the Fed did it. That's an incredibly lazy answer. Why are rates low? The Fed did it. Why are rates high? The Fed did it. Why are rates volatile? The Fed did it. It removes all responsibility from your shoulders as why are rates changing. It's true, rates in the last decade were low. But to show you why they're low, I'm going to create what I call an intrinsic risk-free rate. I've been doing this for a long time in terms of computing this number. I'll tell you what I do. What did we say goes into risk-free rate? Expected inflation and an expected real interest rate, right? I took the inflation rate every year. I know it's reaching, but I took so let's say the inflation rate is 3%. I took the real GDP growth in that year. Say it's 2%. Add 3 plus 2, you get 5. That's my intrinsic risk-free rate. That's basically what you're getting in these columns. The red number is the inflation, the green is the real GDP growth. That's my intrinsic risk-free rate. The black line is my actual T-bond rate. Do you think the two seem to move together? You can do the correlation if you want. You can see there are years, but clearly the trend lines match up. The correlation, I think, was 88%. Look at the last decade, 2011 through 20. What do you notice? Lowest inflation decade in a century. And in terms of real growth, anemic real growth. What's low plus low? Low. Why were rates low in the last decade? It wasn't the Fed, it was low inflation plus low real growth. Did the Fed at the margin affect rates? That's causing that noise around the number. Of course it does. In fact, in 2022, rates shot up and people blamed the Fed. What happened in 2022? When you started paying for things and noticing that things were going, my burrito, which was at $9.99 for an entire decade, became $14.99. You think the burrito, who cares? But that played out across the market, right? We saw 8% inflation for the first time since the 1970s. Inflation was back, and guess what the T-bond rate did? It went up. What did the Fed do? Chase the market. It raised rates, but it was chasing the market all the way through. So when you look at rates, I want you to remember, ultimately it's inflation and real growth that drives those rates. The Fed at the margin can do only. So if at some point in this year rates go up and you say, why isn't the Fed lowering rates? It can't do much if inflation is back and real growth is strong. Final point about risk-free rates, talked about currencies with negative risk-free rates. And it does freak people out. I understand why it freaks people out. It's changed. I mean, all these currencies now are back to positive numbers, but the Swiss franc, the euro, the Japanese yen in 2019 all had negative risk-free rates. It's kind of unnatural, right? It actually created these very strange things in Europe where Danish homeowners who bought a house with a mortgage, the bank mailed them a check every month because the mortgage rate had become mildly negative. It's not something you even think about. You say, I borrow money and you pay me? This is amazing. But that's what negative rates do. It kind of turns the whole word on its head. But there's a problem with negative rates, right? You can't go below a certain number. Why? Are you required to put your cash in a bank? So if I say the rate is minus 1%, if you just hold as cash, you keep the money, right? You're saying, why don't people just keep the cash when you have negative rates? Let's say you have $10 million. Let's say you decide to keep it all at home. First, don't tell me where you live, because I might pass the message on. You first have to hire, all kinds of security, and who knows, you might have things eating through paper, and the currency gets eaten. The problem is we've created a world where cash, we don't use cash anymore. 50 years ago, interest rates might not have turned negative because we were used to carrying cash, paying with cash. I've been behind people in a line whose Apple Pay stops working, and it's almost like, oh my God, my life is done. How am I going to pay? Have you ever seen this thing called currency? You might want to put in your pocket just in case. In a cash-free society, rates can turn negative, but they can't become minus 10%. There's a tipping point where people just hold the cash but rates can turn negative. And if they do turn negative, the question is, should you continue to use them? Because remember, you start with the risk-free rate and build up to it. You start with the negative number. You're going to come up with a low cost of equity and low cost of capital. So that was the fundamental question I was asked from European analysts is, hey, euro risk-free rates look negative. Should I make it positive? You know how some of them made it positive? They took the minus and they drew a line through it and said, it looks plus. It's magical. You can't do that, right? Others use the normalized approach, take the average rate over the last 10 years, but that became a fundamental question. So we'll come back and talk about it because I'll value Heineken in September of 2019. But the euro risk-free rate was negative. And I'll give away what I did. I left it negative. But then when I did cash flows and growth rates, you saw that same negative phenomenon kick in there. I actually found Heineken to be overvalued, not undervalued, even though rates were negative, which dispenses this whole mythology of rates get really low or they get negative, the value is going to explode through the air. Just be consistent. You control both the discount rate and the cash flows. As long as you're consistent about your assumptions, you can use low rates, high rates, negative rates, and it's all going to even out. Yes?
Those banks had negative rates. Was that government enforced or did the banks take?
It's market set, right? It's demand and supply. The T-bond, the euro bond, the German euro bond, it's demand and supply. There were bond buyers actually willing to buy these bonds with negative rates. Banks, in a sense, are triggered to that. So it's it's got nothing to do with government regulation. It's just you're in a deflationary environment, negative growth, the bottom falls out. Let's talk about uncertainty. Now, a lot of stuff on this page, but my point when you talk about equity risk premiums is everything affects it. Let's go through the list. First, does it depend on your risk aversion as a person? Absolutely. And what determines risk aversion? First, yeah. One is life experience, but some of it basically you're born with, right? I have 4 kids. I can tell you which one of my kids is going to be invested in fixed income for the rest of his life, and which one's going to be the option trader. My oldest son, he's 35, still walks down the stairs holding on to the banister. I might fall now. How about right now? Fixed income guy, if you ever saw one. My youngest, when he was 2 years old, took off from the top step, expecting to be caught before he hit the bottom. Option trader to the core, right? So some of this you're born with. Second, do you think age matters? Are older people more risk averse or less risk averse? Why? Because you've learned what life can dish out. You're older, you have more responsibilities. So you know what the implication is, right? As a market ages, what should happen to equity risk premiums? It should actually get higher because the Japanese market has a demographic problem. Equity risk premiums are going to be higher there. The Chinese market has a demographic bomb waiting to go off. And if equity risk premiums go up, what's going to happen to stock prices? They'll have to go down because you'll have to get a higher return to compensate. Do you think I'd be treading on dangerous territory that your sex matters? Are men more risk averse than women, or what do you think then? Young women are more risk averse than young men. My 4 kids learned how to drive. The only one of my kids whose car I would get into when they drove was my daughter. Because I've seen what 20-year-old men can do in a car, and it is terrifying. Young men are actually the most dangerous risk-taking group you can think of. And this is what I want you to do. Next time you go to an investment bank, walk into the trading room and look around, and what are you going to see? 25-year-old men, maybe 30 if they're old, in front of computers playing with tens of millions of dollars. So after one of these trading scandals, I wrote a piece on my blog, it's still there, suggesting how banks can take care of this problem. First is you can make your traders more diverse. That takes a long time. I said, here's what you need to do. What's your only check on a 25-year-old male taking too many risks? A mother. A mother, not a family. They don't listen to their siblings, right? They'll actually take more risks. Father, who cares what he says? So I said, here's what you need to do. You hire a trader, hire his mother too. Make her sit in the chair behind saying, what are you doing now? It'll slow the process down. He said, what? You don't do that. It's good to have it's the greatest risk tool you can think of. You're saying, but I have to pay the mothers? Hey, think $100,000 a year for not having that $2 billion trading scandal. It's well worth it. Risk aversion varies across people. Does it vary across time? Yeah. I mean, remember, COVID, you started the 2020 feeling pretty good. In my March 2020, so I don't know whether I have a future left. It can vary across people. It can vary across time. Second, More economic uncertainty will lead to higher equity risk premiums. Little later in this class, maybe in the next class, we're going to talk about why equity risk premiums vary across countries. Okay? If you're in Venezuela, you feel an immense amount of course your equity risk premium is going to be higher. But even in a market like the US, as you go through time, could you feel, I mean, mention of a tariff does increase economic uncertainty. I'm not taking a political stance here. It just makes the future a lot more uncertain. Your equity risk premiums will reflect it. Third, inflation and interest rates. I'll tell you the problem is not inflation per se. That does cause rates to go up. It's when inflation goes up, it also becomes more unstable. When inflation becomes unstable, it basically makes everything more risky, higher equity risk premiums. Do you think the way information comes to equity markets affects equity risk premiums? Right? Where does the information usually come from? Comes from companies which are required by disclosure to reveal it. And if there are holes in disclosures, that's going to affect your equity risk premium. Countries where disclosure laws are not as complete will have higher risk premiums than countries without. What about liquidity? Yeah, you're in a market where you don't have much money flowing into the market. Egyptian market at one point in time, you know how they recorded trades? There was a guy with a chalkboard. I'm not kidding. In front of the exchange. And every time there was a trade, he wrote in chalk what the trade was. You want to try that in the New York Stock Exchange? You couldn't keep up, right? But there were so few trades, they could actually didn't even fill the board. So you're a market where there's a lot of liquidity, the equity risk premium should be lower than in the market where liquidity dries up. But even in a market like the US, are there periods where liquidity dries up? I remember October 2008. GE could not place its commercial paper. Largest commercial paper issuer in the world was unable to place the commercial paper because there weren't enough people willing to buy it. Higher equity risk premiums. What about catastrophic risk? Don't mean to scare you, but you wake up one day and you hear about a nuclear bomb that's been launched. I'm sure you'll have other things on your mind than equity risk premiums. But worries about nuclear war will play out as a higher equity risk premium. So that's catastrophic risk. Can government policy affect equity risk premiums? Yeah. So if you have a government whose policy is unstable, it keeps changing, the equity risk premiums will have to reflect it. And finally, can central banks affect equity risk premiums? I think so, and I'll tell you why. A good central banker should be, in the old days when you had children, you know what they used to say, right? They should be seen and not heard, a terribly cruel thing, I'm sure, in hindsight. But central bankers should be seen and not heard. Because when they talk too much and they talk about what they're going to do, they can add to the mix. That's a long list, right? You're saying everything affects equity risk premiums. Welcome to the real world. That's exactly right. Everything that happens around you, small or large, is affecting equity risk premiums. Which means equity risk premiums can never be a constant number. This morning, when I was teaching my corporate finance class, somebody who works at a regulated company came in and said, is there a way I can get a way of getting equity risk premiums where it doesn't change much over time? I want something nice and stable. I said, you live in a world where everything is changing. Picking a number that's stable might make you feel more comfortable, but it's not real. A good equity risk premium number should be unstable, should reflect the time series. So let's start with the conventional way in which most people still estimate equity risk premiums. They look backwards. And when you look backwards, there are two things you're assuming. First is that things will revert back to the way they used to be. It's called mean reversion. It's a very, and I'll admit, it's a strong force in businesses and markets. Things revert back often. So if you have a basketball player who historically has shot, 45% of his three-pointers and he's shooting 20%. You say, well, he's just having a bad patch. And odds are that if you watch him over another 10 games. But if it's Steph Curry, that might not work. Why? He's got a great lifetime average. He's shooting well below that lifetime average this season. Why is assuming mean reversion not going to work? He's getting older. There's been a structural change in the process. You can sign Mike Scherzer, but he's not going to win or pitch with the ERA because he's older. You're saying, what's this got to do with historical risk premiums? When you look at the last 100 years of the stock market in the US and you get equity risk premium, not only assuming equity risk premiums mean revert, but you're also assuming that the US equity market has not really changed. You see why the 2008 to me was the wake-up date for this. What did 2008 show us? First, that the line between developed and emerging markets was a hazy one. There was this gray line. On any given day, who knows what any market could look like. The second, you shouldn't have needed the reminder, but a lot of us got the reminder anyway, that the US was not the global economy anymore, that we were all connected at the hip. In other words, it's saying the structure has changed. What the heck are you doing looking at 1926 through 2008 averages? But people continue to do it. So let's look at what the numbers look like. On my webpage, I update this at the start of every year. I never use it, but I update it anyway. So basically, this is my version of the historical risk premium you might find in one of the one of the commercial sites out there. It's very close because we draw on the same date. It's the same market. Now, there's my historical risk premium for the US. Let me rephrase it. These are my historical risk premiums for the US, plural. You say, how come you have many? Depends on what slice of history I look at. I can go all the way back to 1928, which is my starting year. I could go back 50 years. I could go back 10 years. I could go back 20 years. Each slice is going to give me a different number. It's going to depend on what I use as my risk-free investment. T-bills are short-term. T-bonds are long-term. I get different numbers. It even depends on how I compute my average. Sounds mysterious, right? There are two ways you can compute average. The conventional is, if I have 100 years of returns, I add 100 numbers up and divide by 100. That's a simple average. The second is what's called a compounded average. The nature of investing is returns compound. I'll give you a very simple example to bring it home. Let's assume you have $100 today. You invest in something, it doubles next year. So what's your percentage return next year? 100%. And the next year, the year after, it halves. What's the percentage return in year two then? If it halves, minus 50%. You know what the arithmetic average return over the next 2 years is? No, it's plus 25%. Through the magic of averaging, I've convinced you that even though you start with 100 and end with 100, you made a 25% return. That's the problem with arithmetic averages. The truth is, you made nothing. You're back to where you started, and geometric averages capture that. So let's look at the range of numbers here. It ranges from, I think the lowest value I got at the start of 2025 was 5.44%, and the highest number I have is 13.5%. You see why equity research analysts like a table like this? Remember we talked about bias? What does bias do? We want to come up with a high number for a company. You're going to pick an equity risk. Which premium are you going to pick if you want a high number for your company? The lowest number or the highest number? You're going to go with the lowest. You want a low number for your company, you pick the highest. It's like being in a buffet. You pick the equity risk premium you want, you get the answer you wanted to see. It's a recipe for disaster. And they've forgotten basic statistics. Remember those standard errors? When I tell you the historical equity risk premium for the US over T-bonds, and I'm going to stick with T-bonds because my risk-free rates are long-term, and I'm going to stick with geometric averages because discounting compounds, 5.4, if you force me to pick a number on this table, I'd pick 5.44%. Then I'm going to put a caveat. The standard error in that number is about 2.12%. Somebody want to help me out there on what that, Claire? Why don't you tell me what, if I have a 5.44% equity risk premium, and so let's round it up, 5.5% equity risk premium, 2% standard error. Tell me, I know nothing about statistics, you have the data. Tell me what that tells you about the equity risk premium going forward. With one standard deviation. And when you do that, well, how much confidence do you have in your number? 67, which means you can be wrong 1/3 of the time. That's a lot of times. So could you give me something more precise? 95% confidence, 2 standard errors. And with two standard errors, what are you telling me? It could be anywhere from 1.5 to 10%. Fat lot of good. That does mean a valuation, right? And that's exactly what people are building valuations on. A number that's got such a wide range. It could be 2%, it could be 10%. It's backward looking, and it's definitely noisy. There's a reason I haven't valued a company with a historic risk premium probably in 25 years. It's this reason. I don't trust it. I don't know what it tells me about the future. So the estimates are noisy, and I like the word noisy, but it's basically reflecting the statistical standard error. See, couldn't I look at an even longer time period? In the US, you can go back to 1871. There's data going back to 1871, but there you run into a little bit of a problem. You have more data, but you know what the US economy and the US equity market looked like in 1871? Come out of the civil wars, and it was an emerging market. The market itself has changed, so trying to get more data is not going to solve this problem. There is no escape hatch if you just keep digging and digging and digging, trying to get more data. And second, there's another problem when people use this US equity risk premium. They use it outside the US as their equity risk premium. The most successful equity market of the 20th century was the US. And what have we done? We've estimated the equity risk premium you'd have earned in that market. But let's say it was 1919, you're a wealthy person and you wanted to invest your money. You had no idea what was coming in the rest of the century, I would think. You know the biggest equity markets are maybe Austria. You say, I'm going to send my money to Austria, 25% of your money. What happened to the Austrian equity market, you think, after the Second World War? Got wiped out, like my Russian investment in Lukoil. One of the problems with using historical premiums in the US is you're probably overstating your equity risk premium because you've let survive. It's called survivorship bias. You pick the most successful market, you reverse engineering, and you're trying to apply it for the next 100 years. So file that away. Historical risk premiums are unreliable, but I'm going to take a little tangent here and come back to talking about better ways of estimating equity risk premiums. If it's difficult to get a historical risk premium for the US, it's a nightmare to get it for countries outside. Even European markets did not trade. They actually have this break in the historical data, 1940 through 45. The US continued to trade, but many of the markets stopped trading. So you have to start. If you take a market like India, the stocks have been around a long time, but you go back to 1960s, 1970s, you had probably 20 companies that accounted for all the trading, very illiquid market. If you're lucky, you might have 20 years, 25 years of data. And if you went back to the previous page and looked at the standard error, as my time period goes from 100 years to 50 years to 10 years, my standard error gets larger. No surprise, it's purely statistical. I remember a Vietnamese analyst emailed me and he said, look, I'm having trouble getting, I'm valuing the company. He said, can you look over the valuation? And I said, I will, because I'd never seen a Vietnamese company actually valued. I was curious. I looked through, and he has a risk premium for Vietnam, an equity risk premium. I said, where do you get it? He said, I use a historical equity risk premium for Vietnam. How long have equity markets been in Vietnam? If you're lucky, maybe 15 years, 12 years. He had 10 years of data. He said the risk premium is 6.83%. He had the second decimal point nailed down. And I said, you might want to estimate the standard error in that number before you use this, because the standard error is actually 8%, which means you basically know nothing about the equity risk premium by looking at the past. So you can't go back because you don't have historical premiums. So if I wanted you to value a Brazilian company, you have two choices. One is you can say, come back in 100 years. I'll have enough historical data to estimate your risk premium. But my guess is you're not coming back and I'm not going to be around. The other is to do something today. So I'm going to give you a pathway to estimating equity risk premiums for markets that don't have a lot of history. And I'm going to use a number that we've already used in the context of risk-free rates. So let me do a logic exercise. Let's suppose you have an equity risk premium for the US, right? Let's say you feel whatever, and we talked about historical premiums, they're noisy, but at least you have 100 years of data. And you're trying to estimate a risk premium for a country, an emerging market, a Vietnam, a Brazil. If the equity risk premium for the US is 5.44%, would you expect the equity risk premium in Brazil and Vietnam to be higher or lower? Higher, right? So you can only figure out a way of how much higher, make our lives a lot simpler. So I'll give you the first way you can come up with the equity risk premium for a Brazil or a Vietnam. You start with the US equity risk premium. And remember that default spread that I used to clean up? I'll bring it back into play and say I'm going to add it to my US equity risk premium to come up with an equity risk premium for Brazil. So in, in 2025, let's say my US equity risk premium is 4.33%. I'll talk about where I got the 4.33% later. Remember the default spread I came up with for Brazil, 2.83% based on the rating. You add the 2.833% to the 4.33%. You come up with an equity risk premium for Brazil of 7.16%. So basically, I start with the rating, I come up with a default spread. And you can use the sovereign spread if you don't like ratings. Add it to the US premium. This is, if you can call it that, the state of the art of estimating equity risk premiums at investment banks. They have a base premium for the US. God only knows where it comes from. They added the spread. Now do you see why I took that spread out of your government bond rate? Because if I did not do that, you'd be double counting the same spread, right? Once through what you call the risk-free rate and once through this risk premium. Yep. That's, well, when it's used as a default spread, you're basically saying that's country risk. But I think you're onto something. That default spread of 2.83% is for doing what? Buying a Brazilian government bond, right? But that's not what you think you're doing. You're thinking of buying Brazilian equities. Now, again, I'm going to ask you in two questions and I'll come back to you. Are equities riskier than bonds in a country or safer? Riskier. Why? Because you're always the last guy in line. So you'd expect that additional risk premium for Brazil to be greater than 2.83% to the extent that equities are riskier than debt. 30 years ago, that's exactly where I started. Because this is what investment bankers showed me. And I said, I see where you're starting, but why are you stopping there? The 2.83% is the default spread. Here's what I'm going to do to convert it into an equity risk premium. I want to measure how risky equities are in Brazil and how risky bonds are in Brazil. And I'm going to use a very simplistic measure of risk. For equities, I took the Bovespa, which is the Brazilian equity index. I computed the standard deviation in the Brazilian in the equity index to be 30%. Then I took that Brazilian government bond on which my default spread was 2.83%. I computed the standard deviation, that number to be 18%. Let's do an algebra problem. If you're buying a government bond with an 18% standard deviation, you're demanding a 2.83% spread. You're buying equity with a 30% standard deviation, your spread should be roughly scaled up to capture that additional volatility. The 2.83% then becomes, so you can, I'm sorry, I'll go to the, it becomes 4.25%, and you essentially have an equity. I'll come back to the previous page. So basically, it becomes a larger number. So I've taken the default spread approach, and I've adjusted the default spread for the higher risk of equity. You're saying, what was that middle page? Goldman Sachs, about 30 years ago, came up with a different way of trying to scale for risk. They said this government, they didn't use the government bond at all. They started with the US equity risk premium, and they looked up two standard deviations just like I did, but the standard deviations they looked up, well, one was the standard deviation for the Bovespa, the 30%, and the other was the standard deviation in the S&P 500. You see what the algebra problem looks like there, right? The S&P 500 is an 18% standard deviation. My equity risk premium is 4.33%. If Brazil's equity index has a 30% standard deviation, its risk premium should be much higher. Based on that percentage, you get an equity risk premium of 7.22%. Already, again, just like the risk-free rate, you can see numbers changing depending on which approach I use. I almost never use the default spread approach because to me, it's like a bludgeon. Really, the choice is between this approach, we use just equities, bond doesn't even enter the picture, or the third approach. And I'll tell you one of the reasons I have trouble with this approach. When I use it every year to actually, I use the Goldman approach to see what the numbers would look like. It looks like Pakistan should have a lower equity risk premium than the US. You know why? Because the standard deviation in the Pakistani equity market is actually lower than the standard deviation in the US. Why might that be, Sophia? Because there's no liquidity. Remember, for prices to change, people have to trade. If you're in a market where there's no liquidity, the standard deviation will be close to zero. If I use this approach, any market where nobody trades, oh, that's a safe market. It's the exact opposite. But the problem with standard deviation equity, it's a joint effect of the risk of the country and how liquid it is. So I've tried this and I get some really strange looking numbers. Costa Rica should have a very low risk premium because nobody, I guess, trades in Costa Rica. I guess they're all on the beach or in the rainforest. I don't know what they're doing, but they're definitely not trading. So when you look across these approaches and you think about what to do, you're good jumping around. No, you can see that the approach you will see built into your spreadsheets is this one, where I take the default spread, because that's my base approach. But if you push back and say, I don't like the way you're scaling up, I'll let you use the bond default spread. The different numbers are not different enough for me to take a stand. But essentially, I'm adjusting your equity risk premium for what I think is your country risk. So at the start of every year, I estimate equity risk premiums by country. I start with an equity risk premium for the US, and I haven't done this yet, but I have a forward-looking premium. At the start of 2025, that premium was 4.33%. Let me pause right there. So that's my equity risk premium for the US. And this may sound US-centric, but I'm going to stick with it. I'm going to assume that that's the equity risk premium for any mature equity market. So ask me the question. How do you know whether an equity market is mature, right? I cheat. I go to the ratings agencies, and if they give you a AAA rating, I say you're a mature equity market. I know I'm outsourcing this, but do you really want to go around asking countries, are you mature? Are you not? I mean, I'd get into a whole lot of trouble calling you immature. This way I can blame Moody's. So you know what markets have AAA ratings? Name some countries which have AAA ratings. Let's start close. Canada. I know we're right now preparing for war, and I'm going to show what the war will look like. Canada, AAA rating. In Europe, it's Germany, Netherlands. It's all Northern Europe. Southern Europe, don't even look. It's terrifying when you go below that line. In Asia, there is only one country with a AAA rating. Singapore. The only AAA rated country. Australia, New Zealand, AAA rating. All of those countries are going to get 4.33%. If you're not AAA rated, then the game is on, right? I take your rating, I come up with the default spread. Initially, I used to try to find a government bond in that country, and I finally gave up because there are only like 15 or governments which have government bonds. So I started using a scalar by looking at an index of emerging market equities that S&P has, and an index of emerging market government bonds, which has an ETF. I think JP Morgan maintains. And I take the ratio. At the start of 2025, that number was 1.35. You're saying, how do I use that? Let's say your default spread is 2% based on your rating. 2% times 1.35 is 2.7%. You add that to 4.33%. I've got an equity risk premium for your country. Sounds abstract. So let's look at the numbers. This is what the world looked like to me at the start of 2025. Pick your part of the world. Wherever you're from, you can pick that part of the world. If you're from North America, look elsewhere because there's not much going on in North America. You got Mexico, you got US. Even Mexico, I pushed out of North America. You know how much crap I get with this from people saying you put me in the wrong geography? Or your borders. The worst is when people say you drew the borders wrong. I get a disproportionate large number of Indians saying you got the Kashmir border wrong. Look, I'm not the UN. I'm not trying to arbiter what the borders are. So draw whatever borders you want. This is the most downloaded data set on my webpage by far. It gets used in the strangest places. I remember getting an email from the New Zealand Milk Board. I didn't even know there was a New Zealand Milk Board until I got this email. They said, we're using your equity risk premiums to set milk prices for New Zealand farmers. What? Who are they selling the milk to? Zimbabwe? Okay. But that at least, they said, where are you getting your equity risk premiums? And I sent them this. I said, this is not rocket science. This is what I do. I start with the US premium and look up the rating. So basically the class played out in a 15-minute YouTube video. But sometimes you get emails, you're not sure how to respond to them. Right? I'll give you one of my favorite examples. I get an email from a business person in Lebanon about 12 years ago. And here's how the email begins. You've destroyed Lebanon. I said, what? After 20 years of civil war and Hezbollah, I am the guy who did this? What did I do? And it turned out that he was a Lebanese business person, was trying to sell his business, and an appraiser had valued the business, used my equity risk premiums. And you take a look at Lebanon, not exactly the safest part of the world, right? You put in a risk, it was actually not as bad, but it was like 20% equity risk premium. What happens if you put a 20% equity risk premium into your discount rate? It gets really high. Your discount rate gets really high. Your value gets really low. This guy felt he'd been chipped. It was all my fault. Initially, I was going to say, take it up with your appraiser, but I decided discretion was the better part of valor here. I said, it's not my fault. See whose fault it is? What drives that extra risk premium? Your rating. Your rating is in the toilet. You're going down with it. I said, it's not my fault. It's Moody's fault. If you want to take it on somebody, I'll send you their address. It's 70 Church Street, New York, New York. Okay? And there's no wrong. There's no intellectual firepower behind this, right? But it's completely transparent. I'm not saying that I like this country. I'll give it a lower risk premium. It's entire. You're saying, what is this box at the top? Take a look at the countries in that box. You got Syria. You got North Korea. You got Sudan. These are called frontier markets. Russia is up there now. It didn't used to be. Russia has made it in there. You know what these countries share in common? What did I need to get a country risk premium? I needed a rating. These are countries where there is no rating. The Russian sovereign ratings was suspended in 2022. They haven't come back. It makes my life a lot more difficult because we're not talking about a small country somewhere, right? We're talking about And for a long time, if you didn't have a rating, they didn't show up in my data set. Until I get another email. I get a lot of emails from a Syrian business person. Must be the last business person left in Syria now. And he says, look, I'm a Syrian business person. I'm trying to come up with a cost of capital for my company. I'm looking for an equity risk premium for Syria. I was on your website looking for it. I couldn't find it. Why? It's a very aggressive why. And I said, you know what? You don't have a rating. I can't come up with an equity risk premium. And then he comes back, 5 minutes later, he says, so what am I supposed to do? And I said, you have a point. You have to run a business. So I'm wondering why coming up with a cost to cap for your business is high up on your priority list if you're in Syria. And I'll be looking for a lot of other things. But you clearly have some degree. Maybe you have a competitive advantage and your last name is Sassad. I didn't check. Right? And I said, you know what? I'm going to try to give you an equity risk premium. So here's what I do for countries that don't have a rating. There's a service in Europe called Political Risk Service that attaches country risk scores to countries. That's all they do is they look at political risk, economic risk. So the way the risk score works, and among others, The Economist does that, the World Bank does it. I've used PRS for a while, so I'm going to stick with them. A lower score is a riskier country, a higher score is a safer country. So in 2025, when you look at those PRS scores, the safest country in the world, I think, was Switzerland or Sweden or it's and then of course you get down and you get a mix. And they do the frontier countries. So they do Russia, they do North Korea. So let's take as an example Myanmar. Doesn't have a rating, but has a country risk score of 56. Remember, I'm not a purist, I'm a pragmatist. Guess how I came up with an equity risk premium for Myanmar? I look for other countries which have scores between 55 and 60 that have ratings and an equity risk premium. I found 4. And then what do you think I did? I averaged the 4. You're saying, that is so simplistic. Guilty as charged. If you can come up with a creative way of estimating an equity risk premium for North Korea, I would love to hear it. I haven't figured it out yet. But my table is full. No matter where you operate in the world, I have a number for you. Okay? It's an input that I need. You're saying, how many companies are you going to value that are in Myanmar? I don't have to have a company in Myanmar to worry about Myanmar equity risk premiums, right? If you're a lumber company and you're getting your mahogany from Myanmar, hey, guess what? You're exposed to country risk there. So as you look at these companies, countries, you're going to see difference in risk premium. So now let's seal the deal. We've got a way of getting an equity. I still haven't finished that implied premium for the US. I'll come back to it. But let's talk about these equity risk premiums and how they play out in your company's valuation. The first approach is the default approach you see at many investment banks is you tell me where you're incorporated. I will use the equity risk premium of the country in which you're incorporated. I can't even imagine how you defend this approach, but it is the default approach. So what happens? If you're an Indian company, you get the Indian equity risk premium. If you're a Russian company, you get the Russian equity risk premium. If you're a South African company, you get the South African equity risk premium. You're saying, what's wrong with that? Could you be a South African company? Could be a diamond company, De Beers. Where do you get your revenues? You don't get them in South Africa. You get them in Europe. You get in North America. Your operations could be all over, and I'm giving you the equity risk premium of the country in which you're incorporated. So I'm going to give you a second approach. The second approach, what you do is you start with a risk-free rate, and you come up with a beta, but you bring in that country risk premium of the countries in which you operate into the process. So basically, if you're a high beta company, you're more exposed to country risk than a low beta company, which I think is not unreasonable. But you're asking beta to carry one more weight to all of the other weights it's carrying. Because beta is supposed to measure your exposure to interest rate risk and macroeconomic. I'm saying measure country risk as well. And the third approach, I'm actually going to try to isolate country risk and try to identify whether you're particularly exposed. And I'll talk about some of the things you might look at that might make your company particularly exposed to country risk. So let's start with the country of incorporation versus where you operate. This is the status quo approach, where everything is based on where you're incorporated. So if you're incorporated in a risky country, you're going to end up with a high cost of equity, no matter where you do business. Do you see what kind of effects this is going to have? If you're a South African company, about 20 years ago, a lot of South African companies it's a gold mining company actually that I was talking to, moved their incorporation from South Africa to London. Can you do that? Yeah, move your country over. And I asked the CFO, why do you do this? And he said, will make us less risky. I said, what exactly do you do? Take your mines that are in South Africa, move them to Yorkshire, Lancashire? I mean, moving your headquarters from, Johannesburg to London doesn't make the risk go away. But that's the kind of trap you fall into when you think about where you incorporate it. That drives all of the risk. So I'm going to stay with countries of operation. And within the countries of operation, I now have to come up with a way of estimating the equity risk premium for your company. So if you have a company, it's operating all over the world, what's a one metric you can generally find in that company's financials that's broken down by geography? Revenue is often the only one. So beggars can't be choosers. Use revenue weights. Could that get you into trouble? Absolutely, right? There are times when you worry about where are my factories, where am I? No. So the first is to take a revenue weighted approach of where you operate, bring that into your equity risk premium. The second is you might say, I don't care about revenues, it's where I operate that I worry about risk. I'll tell you the kinds of companies where I don't look at revenues, I look at where you operate. And that becomes, but in each of these cases, what are you doing? You're taking the countries where you either sell or make and use them to come up with a weighted average. So you can be a company in a safe country that's incredibly risky. You can be a company in a risky country that is incredibly safe. Infosys is an Indian company, but it gets 93% of its revenues in the US and Western Europe. Conversely, Coca-Cola is a US company that gets 60% of its revenues from some of the riskiest parts of the world. So what we're trying to do here is break out of that box of where do you incorporate using the risk premium, thinking about what are the countries. And now you see why I need the entire world to value, even if my job is just valuing US companies. Where does Microsoft get much of its software written? Probably in India. Even if they sold nothing in India, how can I just ignore that risk when I value Microsoft? Welcome to globalization. This is the dark side, right? Because effectively, 30 years ago, you could say, I'm going to be working in the US. I don't care about the rest of the world. Now, that's not going to be the case anymore because your companies are exposed there. So I'll give you a couple of examples of revenue-weighted equity risk premiums. Embraer. You familiar with what Embraer does? You can tell me. What does Embraer do?
Regional jets and also corporate jets and defense.
If you take a short haul flight in the US, one of those small jets, most of the time you'll be flying an Embraer jet. It's a very good aircraft maker. It's a Brazilian company. It's incorporated there, but it gets it at least the time that it is. They got 97% of their revenues outside Brazil, mostly in North America, selling to airlines in North America and Western Europe. So in a revenue-based approach, the equity risk premium I'm going to get is going to look very much like the US premium. I know there's a flaw here because Embraer still makes its jets in Brazil. I'm ignoring the production, but they don't even tell you where their factories are. I'm going to go with revenues. Take a look at InBev. What does InBev do? Sells beer. It's part of InBev. Now, it's the largest brewer in the world. But InBev is the Brazilian version of the brewer. And this is in 2011, their revenues came from all over Latin America. They're a Brazilian company, but their risk comes from where they sell, not from where they operate. Most cases, I use revenue weights. So when you value a company, if it's a consumer product company, if it's a, just use revenue weights. I know that but the rest of the information you don't have. I'll tell you one exception. If you're valuing an oil company, don't use revenue weights. Why? Because what do you sell into a global oil market? So if you're an oil company, what keeps you awake at night? Where your oil comes from. Your oil comes from Nigeria. Guess what? You got to worry about Nigerian country risk. So if you have a company where that's the case, you might bring in where the oil comes from, make those your weights. So last example, I talked about Coca-Cola and how it gets revenues all over the world. There's the equity risk for Coca-Cola. You're saying, why is it broken down by region, not by country? Practically, you know why Coca-Cola doesn't break things down by country? That table will run 72 lines, right? Many companies will break things down by region. If you go back to that picture I showed you, notice there's a regional equity risk premium. You know what that regional premium is computed as? A weighted average of the equity risk premium of the countries and weighted by GDP. So I'm doing the Asia equity risk premium. China and India will be weighted a lot more than Vietnam in that premium. The reason I compute them is there are companies like Coca-Cola which don't break their revenues down by country, they break it down by region. And as you can see, it's sometimes wrong. When you look at this data for your company, be ready for some frustration. Lisa, you had a question? It'll still break it down. They'll do revenues by region. So if you're Accenture, for instance, which provides services, they have a geographical breakdown of their clients and where they get their revenues. Right? So it's not service versus product. It's more a question of, do they do the breakdown? That makes you risk less, right? So in a sense, that's more for production than for revenues. It's not easily transferable revenues. But maybe that's why the reason I don't care as much about where Infosys' factories. Because if India goes to hell in a handbasket, put 3,000 software engineers and you fly them to some island in the middle of the Indian Ocean, you got your production still back online, right? So that's a good question to think about, and we'll talk about in the context of Lambda. One final point, when you look these, so this is why I want you to pick a company, because if you look at the footnotes for your company, they will have this geographical breakdown. And some companies, it's incredibly frustrating in terms of how they break it down. US companies are among the worst. You know what the typical breakdown of revenues for a US company? We get 72% of our revenues from the US and 28% from the rest of the world. Come on, guys. The rest of the world is a really big place. Is it Europe or is it Venezuela? It makes a big difference. Or European companies have their own vision of hell when it comes to this, right? European companies will tell you, we get our, 35% of our revenues from the UK, 45% from EMEA. You know what EMEA stands for? Europe, Middle East, and Africa. You bundle those three, I have no idea what you're talking about here. I remember, and I'll leave you with this, so as you look at your companies and you look at the breakdown, be prepared for the data not being complete. Work with what you have. And if you picked a company, try doing this for your company. You saw that page, got the updated equity risk premium, see if you can get a weighted average.
Hey, how are you?